Okay, we are on week 7 and week 8 will be released tomorrow. I do want to give you a little bit of preview of week 8 of lesson number 8, which is just a fall so that you can see how those numbers look. And it's better to visualize it when you're on a tax return. But we know if we're going to take it way back to lesson 1, right? We started first with just the entities because we know that in order for you to elect S corporation status, you must first be legally formed as an entity with your Secretary of State. And there's several ways that the clients can form themselves as a business recognized by the state. Most of the times we see them form as an LLC, whether it's just them, one person, a sole member LLC, or it's a husband and wife LLC. And both of those statuses are considered disregarded entities. Of course, we know husband and wife, if they are in a community property state, then it's disregarded as well. It counts as one person. And by default, you will have to file your business activity, income, and expenses on a Schedule C, Schedule E, or a Schedule F with your 1040. However, if you're not in a community property state and your husband and wife that have formed an LLC, you are a multi member LLC, or you have formalized a partnership and have registered with the state as a legal partnership, or even if you haven't registered as a partnership, but just two friends get together and start doing business together, then by default, you are a partnership and you have to file the Form 1065. If you do formalize yourself as a C corporation, and that's how you register with the Secretary of State, regardless if you're just one person or you're more than one person, you are a corporation with your state by default. The IRS will be expecting from you a corporate return, an 11, and a Form 1120. And if we don't like those defaults and we want to do an S corporation, we want to elect to become an S corporation, we can go ahead and file the Form 2553. And we know that it's due by March 15th of that 1 year if we want to elect S corporation status as ideal as the first day of the year because it's due the 3 months and 15 days after. Now we know that the 8832, that's a two-step process for those partnerships. The ones that are by default a partnership. They have to first do the 8832 to elect to be a C corp, and then shortly right after the 2553 to become an S corporation. But before we do the S corporation route, because we know that the number one reason why we want to become an S corporation is to save on that self employment tax, which is what we're used to paying when we're a Schedule C. And when we are an S corporation, we only have to pay payroll tax, which the company, the S corporation, is able to deduct half of that as a payroll expense on their 1120, on the 1120S. We only have to pay the payroll tax on the reasonable wage, the reasonable compensation that the shareholder is supposed to receive. Any profit after that flows down to the S corporation shareholder, no longer do you have to pay any type of self employment tax. Before, as a Schedule C, you were taxed 100% on that profit for self employment tax. And we know that before we become an S corporation, eligibility matters because not everybody could qualify to become an S corporation. Who is the owner of that entity? Who is the owner of the LLC, of the corporation, the one that is trying to elect S corporation? Is it eligible shareholders? Eligible shareholders are individuals, whether they're US citizens or US residents. And US residents only is for tax purposes because it could be an ITIN holder that has been here long enough to meet the presence test. Then at that point, they are considered a US resident only for the purposes of tax, not immigration. But then we do run into a block for that. If that ITIN holder is active in the S corporation, they should be receiving a reasonable compensation. But we know that those ITIN holders, and ITIN is just really an ID for tax purposes. It doesn't guarantee any type of legal status for employment. So, employment law, we cannot issue a W 2 to an S corporation owner that has an ITIN, that is an ITIN holder. Other types of eligible permissible types are those owners of the LLC or the entity, the business entity, if they're a trust or an estate. Then we can also elect to become an S corporation. We have a rule that you cannot have more than 100 shareholders in an S corporation. Now, it does matter more if you have family members that are part of the S corporation or maybe husband and wife. Then, for the rule simply of counting how many shareholders are part of the S Corp, we can count those family members as one person. And then the one class of stock, which is the one I've told you has been broken. This rule has been broken by many, and they have involuntarily terminated their S corporation status without even realizing. And that happens, and it's more frequent when you have more than one shareholder owner of the S corporation, because these shareholders like to go into the bank account after they've paid themselves their reasonable salary. Maybe they need some more money, and they take it out of their bank account, out of the bank account of the S corporation. But when that happens, we know the rule is that every shareholder has to take money out according to the ownership percentage. For example, if a total of $1,000 was taken out of the S corporation bank account and it was all taken out by only one shareholder, that shareholder has to pay back what was over the amount of their ownership. If they only owned 50%, they were a 50% owner, they should have only withdrawn $500. And the other shareholder, the other 50% owner, should go in and receive the other $500. They cannot be uneven distributions that are not aligned to their ownership percentage. Because when that happens, when we notice that on the books, when distributions are not according to the ownership percentage, we do have to go and confirm that the governing documents of that S corporation do properly state that distributions, including liquidating distributions, have to be according to the ownership percentage. Once we confirm that those governing documents are stating exactly that, and that there is no mention of preferred stock, then we have to go to the client and have them correct that. What happens if you do find that type of language of preferred or preferential treatment to one shareholder over another? Then you have, or the entity has created more than one class of stock. At that point, we need to let the client know those documents have to be amended, have to be corrected, because if not, we're no longer going to be eligible to be an S corporation. This is a test that has to be met year after year, that the governing documents don't change. And if they do, that it doesn't affect any type of S corporation status for the one class of stock, that distributions continue to be respected for the ownership percentage, and that also that the eligible shareholders continue to be eligible shareholders. This is not a one-time test that we meet. Again, it's year after year. We have run through our lessons where we talk about S corporations, their flow through entities, pass through entities. They don't pay tax at their level. The only time that we do see tax that is paid at the S corporation level is when that S corporation used to be a C corporation. Now, remember when I said by default, if you are formed as a C corporation with your Secretary of State, you by default have to file the Form 1120. And maybe that C corporation was filing the 1120 year after year, but then one year they decide to elect S corporation status. They're allowed to do that with the Form 2553. However, we have to come in here and make sure that we're meeting these tests year after year. Because when you were a C corporation before, the C corporation has always had to pay the 21% flat tax rate. That's something that came to us starting the year 2018 with the Tax Cuts and Jobs Act, a 21% flat tax rate. But in exchange, if we ever want to become an S corporation, we need to make sure that we keep track of those accumulated earnings and profits that are coming through from the C corporation. Because any distributions that come out of the S corporation, we learned that with with the prior lesson, lesson 7, the distributions first have to come out on the Schedule M2 out of the AAA account. And then the next level, it has to come out of this accumulated earnings and profits. And that it has to be paid. Dividend tax or the dividend is subject to tax at the S corporation's shareholder level on their form Schedule B. It's a taxable dividend. Another problem that we run into when C Corps used to be, or when S Corps used to be a C Corp, is that they have to meet this passive investment income test year after year. Because if they fail this test 3 years in a row, then at that point they are terminated as an S corporation. If they fail it 1 year, then at that point they're subject to the sting test tax, which is a 21% tax. The passive investment test is when the gross receipts that we see on the balance sheet, on the assets, on the cash, any kind of income that the client has received, and we have to measure how much was sales income, service income versus how much was investment income, interest income. Once we start measuring that, and if investment income is greater than 25%, they have failed the passive investment income test. So I will tell you at this point, when you are a C Corp, electing to become an S Corporation, we need to make sure that we're charging more than what we usually charge for S Corp returns, because this is something that we have to be diligent about measuring year after year. And we have to make sure that we know how to remove when the distributions are coming out of the S Corp, out of which column on the Schedule M2 do they have to hit. And that dividend have to be taxed at the S Corporation shareholder level on their 1040 Schedule B. Also, we have the big tax, built-in gains tax. Another problem that comes when you used to be a C Corp and now you're an S Corp, the assets that come through from the C Corp, if you do sell any of those assets within 5 years, you are subject to the built-in gains tax. Then we looked at separately and non-separately stated items, which is something that we have to make sure that we're paying attention to the profit and loss statement. Either if we worked on it or if somebody else worked on it, when we're looking at the profit and loss statement, we need to make sure to extract the separately stated items. The most common are the capital gains. So if we see sale of assets, if we see interest income, if we see dividend income, any type of separately stated items, because they have to retain their character when they flow down to the shareholder. So they're never going to be on page one as part of the business's ordinary income and loss. Instead, they have to be separately stated to flow down to the shareholder. On the 1120S, Schedule B, we talked about how it's just an interview. The IRS wants to get to know your client. What do they do for a living? What is it that do they generate? Is it on a cash basis or an accrual basis? Have they issued the 1099s? Do they own any kind of digital assets? It's a questionnaire that you just kind of have to go line by line to see if any of them apply, have a checkbox of a yes. Most of the time, most of the cases that I've seen, they're always going to be no, but it is one of those that I still have to make sure I read and acquaint myself with those questions for every type of S Corp client that I have. On the 1120S, we also have Schedule M1, which is a reconciliation of book income to tax income. Because again, the profit and loss statement is going to show me an amount of income, which is book income or a book loss, but it's not going to be the same as taxable income or taxable loss, because a tax law is very different from accounting principles. We know that for accounting principles, you can deduct 100% of business loss of business meals. You can deduct 100% of entertainment expenses if they were needed for the business, not for tax purposes. So how do we account for those differences between tax and accounting? We do it through Schedule M1. So we see here just a layout of where we start with business income per the books, and then we flow down to what is taxable towards the bottom right. Reasonable compensation. We went through examples on how to help a client determine what the reasonable compensation amount is. Of course, there's softwares that do come with a price, like RC reports, where it goes through a questionnaire that the client can answer, and it provides all of this backup and paperwork that we would need in case there's ever an audit or a question about how we came up with the reasonable compensation amount. But there are ways that we can help our clients if they don't go through the route of the RC reports where they pay the extra fee, which a lot of practitioners do add that to their billing service. They call it a reasonable compensation analysis year after year, because it's something that we need to make sure that we determine year after year. The shareholder could be doing either more work or less work than what they were getting paid last year. And so it is an assessment, a yearly assessment. So we could come to a place where we are billing our clients for more of an advisory, a monthly advisory, which includes reasonable compensation analysis. And we build that price for our C reports into our advisory services. Because we know reasonable compensation, if there's no reasonable compensation or very low reasonable compensation, that's a red flag where the IRS can come back and determine and reclassify all of those distributions that are coming out to the shareholder and reclassify them as wages and then subject to penalties and interest because we never filed payroll reports according to the newly adjusted amount that came after the IRS audit. But it's something that we need to make sure we help our clients with, of course, if they're paying us to help with this. But we need to make them aware of reasonable compensation rules because we can use the market approach and the cost approach when we determine the reasonable compensation because it all depends on how much of what they're doing for their business and the area where they live because how much would they pay somebody in their area to do the same thing. The fringe benefits. The S Corporation, yes, they're allowed to pay the shareholders' health insurance premiums. They're allowed to contribute into the shareholders' HSA account, but it comes with some strings attached because the fringe benefits, those premiums that were paid, have to be on box one, adding to the wages of the shareholder. They're subject to federal income tax. They don't go on page on box 3 or 5. They're not subject to Social Security or Medicare tax, but they go on box one, the contributions to an HSA account or also any shareholder health insurance premiums that were paid on behalf of the S Corporation shareholder or any that maybe got reimbursed were reimbursed to the shareholder because then the shareholder is going to take the amount of how much that the premiums were or the HSA contributions were and they'll put them on the form 1040 schedule 1. So it really is a wash. The S corporation is able to put them on box 1, it's taxable income, but then we get to reduce our income by putting them on schedule 1 for the S corporation shareholder 1040. And then we talked about bases, how important it is that, yes, if you're hired to only do the S corporation return, you don't have any responsibility when it comes to bases, because this is a responsibility that comes with the shareholder taxpayer. And of course, we know shareholder taxpayers are not calculating bases on their own, but instead, the tax preparer that is helping that S corporation shareholder file their 1040 would have to come and help them with bases. Of course, this is something that we would have to charge our clients extra to help them maintain their bases because it is so important when they receive distributions out of the S Corp. Is it taxable? Well, the next question is, do you have enough bases? What about those tax or the deductible losses? The S Corporation might not have done very well and has a loss, a business loss that flows down on the K1. Can we take that loss on our 1040 against other income? Again, it depends on basis. And then we talked about the gain or loss on stock disposition. One day, the shareholder might want to just step away and sell his stock or her stock in that S corporation to someone else. How much tax are they going to pay on that gain? Well, first, we need to determine basis to determine the gain. So, yes, very important to always track basis. And this is something that you have to do, you, the shareholder, or you, the one helping the shareholder, year after year. And so the question that when we have a new client and come to us, and maybe it's an existing S corporation client or a shareholder of an S corporation, and we're helping them reconstruct bases. The first question is, how did you acquire that stock? Maybe they were an LLC and elected S corporation right away on day one. Well, how much money did they deposit into the bank account? Or they were operating as a Schedule C, taxed on the Schedule C, and then they elected S corporation. What did the balance sheet look like the day they elected S corporation? Of course, if we're reconstructing bases, this is a lot of going back down memory lane and pulling a lot of records that from the day when they became an S corporation. But it's going to be worth the time because it's something that you want to make sure that we track bases accurately because it impacts the taxable gain when and if the shareholder were to ever sell any shares, maybe 100% of the shares, or maybe just a few shares down to the kids. At that point, if they inherit the shares, what's the value of the client's bases that's going to pass down to the kids as a gift or an inheritance? because we have to make sure that when we track basis, basis comes in two places, or comes in two parts: stock basis and debt basis. Of course, if there's no loans between the S corporation and the shareholder, or the shareholder to the S corporation, we don't worry about debt basis. Stock basis is the one that we always have to track, because it starts off with the initial stock basis of how they acquired that stock. From there, year after year, we have to follow this order. We have to increase it by capital contributions, by income items that we see on the Schedule K1, and then we reduce it by distributions. And we reduce it by losses that come on the K1, and by deductions, like the charitable deductions, the non-deductible expenses that are flowing down. All of this, we see this on the reported on the Schedule K1. And we know if you fail the basis test, if there is a loss from the K1 and they have failed the shareholder stock basis and debt basis, is now zero, because you can never go below zero. What happens to that loss? That loss is suspended. And we learned suspended losses. You can carry them forward forever until you start recovering some of that stock basis. Then we can start releasing those suspended losses and are able to deduct that against other income on our 1040. The bad thing about suspended losses is that if we were to terminate the S corporation one day and we said, we're done with the S corporation, I'm retiring, I'm not selling it, I'm just closing it down. Or maybe we're selling it. At that point, you cannot release suspended losses. They get lost forever, because you no longer have any more economic investment into that S corporation investment of yours. You've exhausted all of your economic investment, because remember, stock basis, it's all of your money in that you have deposited, that you have contributed, and you start increasing it by any income that flows down to you on the K1, because you're paying tax on all of that income. So it keeps on increasing. But then we start reducing it by money that starts coming out of the S corporation, or losses that we're able to deduct on our 1040. So at the end, if we're with zero basis and the S corporation terminates and we have some suspended losses that we weren't able to take, those get lost forever. Very different from passive losses, that if you are limited on your losses due to passive activity because you are not active in your S corporation, or very commonly is what we see passive losses with rentals. If you have passive losses due to rentals and you dispose of the rental, you sell it off, at that point, you're able to release those losses against any income. But suspended losses get lost forever. Because we looked at the 4-level loss limitation sequence in lesson 7, where we talked about, of course, stock bases, there's stock and debt bases. Because when you have a loss on the K1, you have to meet each of these 4 tests before you're able to determine if you can deduct that loss on your 1040. Stock and debt. If you have enough stock bases and debt bases, you're good. Let's go on to at risk. At risk and stock bases, they're most of the time are the same, because it's your investment. How much will you lose if this S corporation fails? At risk really comes into play when there's loans on, or any kind of liabilities on the S corporation balance sheet. Because at that point, we need to ask the client, any of these loans between the S corporation and maybe another financial institution shareholder, are you personally liable for these loans? Did you sign off on them as a co-signer? Did you personally guarantee these loans? Which we know that most of the time, businesses, when they get business loans, they're going to want an individual to sign off on these loans. And if the shareholder is personally liable for these loans, even though it's not a shareholder and S corporation loan, it does matter, because it's going to increase our bases in at risk. They're at risk for that type of liability. And then the third test, once they meet the at risk test, the next test is the passive activity loss, which most of the time we won't have to worry about it if we have a sole shareholder of an S corporation and it's just talking to the shareholder. How active are you in your business? We probably know our clients very well. Well, we know they're receiving a W-2. We help them determine reasonable compensation. We know that they're wearing all these hats with the business, so they're very active in their business. Passive activity loss limitation, the test, we only have to worry about if this client, if the shareholder is not very active. Maybe they're getting to a point where they're retiring and they're putting not that many hours. Maybe they're working, I don't know, half the year, and at that, it's very part-time. They're really just brought in for like the major decisions of the business. Maybe at that point, the hours that they're investing in it, they're not as dominant. So at that point, we do run into the risk of, well, this is really a passive activity. And if you have a loss from a passive activity, we know that you're limited. You can only deduct passive losses by passive income. So you need to find other passive income to deduct this loss. But yes, most of the time, we don't run into this type of scenario for those sole shareholders that are very active in the business. And then once we meet all three tests and we determine no, they're not passive, they've materially participated, can we still take the loss? We have just one more test to meet, which is the excess business loss limitation. This one too is very rare because what happens with the excess business loss limitation, you have to take the losses from all of that clients, all of that shareholders' businesses. Maybe they have Schedule C businesses, maybe they also have other K1s. Did any of those activities generate losses? If so, let's bundle them all together. And are they under the annual limit for the business loss limitation, which is about 600,000 for the year 2024 for a married filing joint couple. So if your losses, if you aggregate everybody's losses and it's over that amount, then you're limited to only be able to deduct the annual limit. The rest gets carried forward to next year. So those are the four tests. For lesson 8, we're going to see these tests being applied on a 1040 as an example, just so that we can see how the forms are drafted, how the forms, how the numbers flow from one page to the next, or how they interact with each other. Because some of the forms will reference to, okay, the 6198, have you met your stock and your debt basis? And then once you do at risk, it will tell you if you still have a loss for at risk and you do have basis, it will say, make sure that before you make a flow to the 1040 that you have gone to the 8582 to see if it's required, which is the passive activity loss. So yes, a lot of tests that we have to do when we have a loss on an S corporation if we're helping our clients with their 1040. Most of the times, like I said, I've only gone up to at risk. I haven't had to go into passive activity loss because we know that the client was very active. And then excess business loss, they weren't even close to that much of a loss that they were generating on their Schedule K1 or any of the business losses around them if they invested in any other types of businesses. But with that, we're going to open it up for questions and kind of have a discussion on if we have had experience with these type of losses. When I see a loss on a K1, I go, okay, this is going to be a little bit weird. Let me roll up my sleeves. Let me ask the questions. And it makes it easier if I have a client year after year. It's very, I, especially if I help them with their books, I know the liabilities that are on there. I know that if, I get a copy of the notes, the note payables between the S corporation and the financial institution, are you personally liable? Sometimes I will get a copy of those documents, sometimes I don't, but I'll ask the question if they are liable because it matters for at risk. Um, Again, losses, it's not an automatic, let's deduct it on the 1040 because we need to meet those 4 tests. How's everybody doing with lesson 7? Again, with lesson 8, we're going to look at this on the actual 1040 form. So it makes it, brings it all together on what it looks like in practice. Are we trying to process? Hey, Marty.
I'll be quite honest with you. That was the first one of those lessons that really kind of set me back on my heels. I'm going to have to watch those videos some more because that's the kind of stuff that almost never, when the software is doing all the work for us, those
Mm-hmm.
questions have almost never come up for me unless the client says, well, how do you arrive at that? And I don't necessarily have the rules committed to memory, but I'm pretty good at figuring
Mm-hmm.
out, okay, it happened on this form. Let's go look at that form and we'll follow
Yes.
the numbers and blah, blah, blah. So, I mean, I've
Yeah.
done that with client dozens of times because they want to know, well, what happened? How come something? And you show
Mm-hmm.
them, well, this is what's going on here. So what are you saying? And what I'm saying is there's limits on how much loss you can take at one time. And they
Yes.
go, darn that government, and that whole rhetoric. But
Yes.
so I know I'll often know how to find the form and then just work the math on the form. You just follow it from top to bottom.
Mhm.
But the terminology that you were using and some of the different thought processes and things like that going on there, I was like, yeah, I have no idea what the heck she's talking about. I'm gonna have to go back and read this again.
It is a hard subject to kind of like grasp your mind. And the first thing I say, okay, first off, do we even have a loss? Do I even have to worry about any of this? The test number, of course, stock and debt basis on the form 7203. Yes, always track that, regardless if you have a loss or not. When they have a loss, that's when the 6198, the at risk, is required to be filed if you do have a loss. And so if I do have a loss, then I'm like, okay, now I have to worry about the next three steps, the next three tests that I have to track on this. And yes, the software is pretty good about that. The only thing the software will not know is the liabilities from on the S Corporation's books, if the shareholder is personally liable for any of those liabilities. Because to my benefit or to the shareholder's benefit, if they are personally liable, that's going to increase our at-risk spaces. Because if not, then we've passed, okay, we have enough stock basis, we have enough debt basis. If they have debt basis, we can take the loss. How about risk? Let me just make sure that if stock basis, honestly, if you have stock basis, you are at risk. Because how do we calculate stock basis? Contributions minus distributions, and we're also increasing it by taxable income because the shareholder's getting tax on that income. So if we have positive stock basis, you're going to be your at risk is going to be good so far. The problem is that if you're relying on debt basis to take that loss, so now your stock basis is zero. Our next thing that can save us to be able to take that loss in the 1040 is debt basis. So if we do have a shareholder loan between shareholder and S Corp to cover enough of that loss to be able to deduct it, I'm going to be really happy, but then I need to go to the next step, at risk. Is any of that debt? Now I need to ask more questions on the source of the money that came from the S Corporation shareholder to the S Corp. Where did they get that money? Did they get it out of their bank account to lend it over to the S Corp? Then yes, they're personally liable for that debt. But what about if maybe a random friend let them borrow money and they turn around and put that money into their S Corp? And it's just one of those friends that they never signed any kind of guarantee. I mean, he could be a really bad friend and just never pay that money back, right? Just things like that. How does the IRS compare or prove that my client is not at risk for that money? At that point, hey, your friend let you borrow money. Let's draft something up. Here's a template that you can fill out so that it proves that you are at risk for that money. That if you and sometimes it's like, okay, I'm at risk. What does that mean? If I don't pay my friend back, can he come after my house? Can he come after my personal assets? But it's going to matter for at risk. Again, at risk is not, I haven't run into an issue where they have enough debt bases, but not enough at risk spaces. And this is another thing, like going through the 6198 and the instructions, you can actually have income recapture if you did take a loss due to at risk, but then you no longer are at risk. I'll tell you, this is one of those things that is more reliant on software and me to just step in and kind of look through the 6198. Okay, this makes sense. I am increasing it for more loans that were on the liabilities of the S Corp books that the S Corporation shareholder is personally liable, because the software wouldn't know that, wouldn't consider any of that for debt basis, because loans where that the shareholder is guarantees between the S Corp and a financial institution do not affect debt basis. Isn't this so much? There's so much to keep track of for bases, but it's one of those that we need to know in case it's ever questioned. Because once we have loss after a year, every year we have losses on that K1 and we're taking them on the 1040, that's going to start having come questions from the IRS.
Yeah.
They don't like when we take losses.
No, I get it. It's a lot to take in.
Mhm.
I hate to ask you a question and run, but I have a family
No.
member I have to take to a doctor
Yeah,
appointment.
let's do it.
I'm going to dip out, but you guys have fun, and I really appreciate the group.
Yeah, of course, Marty. Happy to have you here. Did you have another question, Marty, or was that it?
Well, one quick one on the
Yeah.
test. Question 9 baffled me. I ultimately just took an L on it because it seemed like all the answers were right,
Oh, okay. And that could be it. Let me
but
see.
all of the above was not an option.
Okay. And I'll look at it. If you have to run, go ahead, but I'll post it in our discussion hall question. We can look at it together
I
right now.
appreciate that. Thank you.
Yeah. Uh, week 8 or week 7, right?
9.
And
Thank you.
9. Okay.
No, no,
So
no. Yeah,
which,
yeah, 9, 9.
9? Okay. And I will
Bye,
share
guys.
my, okay. Bye, Marty. Here, let's do that. Do we have any other questions? If not, I can share my screen and we can look at our quiz together and
Um,
talk
I
through
don't have
it.
a question, but I have I'm thinking the same.
Uh-huh.
This and the previous lesson was a big aha moment, even because I know that I was the one looking for suspended losses.
Yeah, suspended losses.
Yeah, but I remember in my previous job,
Hmm.
one specific client, he was
Hmm.
after year getting losses and losses and losses,
Yeah.
and he's still in business. And now, when I left the previous job, I was the bookkeeper for that
Uh-huh.
company, but I didn't do the taxes, no, nor the personal, nor the S Corp.
Uh-huh.
But he came back as a bookkeeper client, and uh last year when he asked me, I was hesitating of taking because of
Yeah.
that, right?
Yes.
And I remember that and I'm gonna say maybe 2020, when the first time that I heard about suspended losses, and
Hmm.
I didn't exactly know. I have an idea, but I didn't know how to calculate it or
Uh-huh.
to this class.
Yes.
And the previous one, it was okay. This is a warming up.
Yes. Lesson 6 was a warm-up, right? The stock and debt, because we spent a lot of time on stock and debt bases. And then yes, 7 was a little and definitely it's one of those that I will tell you, you watch it and you're going to finish it and you're not going to be ready to, okay, I've mastered
Yes,
everything.
yes,
It's one of those that with practice and with watching and reading, and it's going to start eventually to make sense. And I remember at the beginning of my career when we looked at risk, I'm like, why? I'm like, oh, stock. Yeah, we had a spreadsheet because before the 7203, we had a spreadsheet for stock bases and debt bases. And I'm like, okay, this is good. And my partner or the partner of the firm said, make sure that you're tracking at risk basis because the basis, the ending basis is going to matter for next year. It's one of those that you roll
mm,
over. It has bases.
mhm,
It's like a basis.
mhm.
And I'm like, what is at risk? And I don't think I remember this at school. And I probably did. They probably taught it to me at school. And I just, you know, but yes, it's definitely one of those, like I said, it's one of those that I get overwhelmed, but I say, okay, do we have a loss? We do. Okay. Do we have debt bases that we're relying on to take that loss? We do. Okay. Now I have to really put my thinking cap on for at risk. And it's hard when you have the S Corporation shareholder 1040 and only. Like if you don't prepare the S Corporation return,
Mm,
then you have to rely on the shareholder with questions of, hey, are there any loans that you remember co-signing on or guaranteeing for the S Corporation? So that they, that they would remember stuff like that. I would hope that they were like, oh yeah, maybe there's okay, can you get a copy? I just want to make sure that you're liable. That it matters now because it didn't matter when we had debt bases. That doesn't count. But it's going to matter now for at risk because my benefit or his benefit, I want to increase at
mm,
risk to make sure we have enough at risk to take that loss. Most of the time, stock bases and debt bases is going to be, if we have enough of that, we're going to have enough of at risk. Rarely is a time when there's a debt between shareholder and S Corp where the shareholder is not personally guaranteeing, like personally liable. Never have I seen a case where the shareholder says, yes, I let the S Corp borrow money, but if they never pay me back, or that money didn't come from my bank account, that money came from my mother-in-law.
Mm.
And if I don't pay her back, that's okay. She's not going to come after me personally. It's very rare. Even if there's nothing written on paper, I haven't come across a human. I mean, there is cases, but I haven't come across somebody that would say that bad. I'm just going to run off. I'm not saying it's never happened, but if, like I said, it's one of those that I rarely have to worry about with the loan between shareholder and S corp, because most of the time it comes from them, or they're refinancing their
Mm.
house.
Mhm.
They're getting money out of that, or they're walking into the bank and getting an advance on a credit card. So yeah, most of the time these are going to be personally guaranteeing. The shareholders are going to be on the hook for those.
And I think for me, I'm glad that the client that I have already
Uh-huh.
are new.
Hmm.
Really, I
Oh,
mean, I help
they
them
just
with,
started the S corp.
yes.
Oh, good. Yes, those are my favorite.
Me too. But I did have during the year 3 clients that
Hmm.
we already talked.
Hmm.
They're doing double keeping. One of them, she's I think I'm gonna take the bookkeeping as well, but
Uh-huh.
she's been in business for a long time.
Okay. Okay. So she's been in the business for a long time,
Yes, with
and
that
the
escort.
same with that
Yes.
S corp, and now you're going to take over. Yeah, the question I would say, let me see your basis schedule, or have you been tracking bases? And
Mm,
most of the time they're going to be like, what does that even mean? And it's like, okay, well, it's going to really matter for us, because we need to track your bases. If you get $1 out of the bank account, the IRS is going to want to tax you on that dollar unless we can prove that you have enough bases.
mhm,
And even down the road, if you want to retire and your business, you want to profit, or maybe sell off some of your shares to bring somebody else with you, we're going to make sure that you're not paying as much tax on it, because we're tracking bases. And so if you haven't never had bases, I offer that service. We can track bases for
mhm.
you from when you started the S corporation, and depending on how many years. I think I told you last class, I quoted somebody $800 for 10 years worth of bases. And then I was shooting myself in the, I was like, oh, maybe I should have done a little bit more, because you have to go through every K1 for 10 years
Yeah.
and go through an Excel spreadsheet, because I couldn't go through a software. For
Mhm.
10 years, I wasn't going to pay a software just to track bases. And so, yeah, it's one of those that it's going to matter of, I have the proof. If it's ever questioned, IRS, here's how I'm getting to basis. Um, yeah, so at risk, when it comes to at risk, if there's a loss and there's enough debt and stock basis, I can guarantee like 90% of the time there's going to be at risk. They're going to meet that test. But
Mhm.
we need to have the 6198,
Okay.
because I had one of the firms that I used to work for, they had gone through one of their clients through an IRS audit where they took the loss, and they were asking, okay, stock basis, debt basis, what about at risk? Were they at risk for this?
Mhm.
And so, good thing that they had filed the 6198 and they had tracked all of that. But yes, it's the IRS is going to really try to figure out how they can tax you on this and disallow a loss.
Yeah. And I'm not sure if you remember, but we
Mhm.
when one of when the 101 that we had with that client, I only did the 1120S. I didn't file for the personal one.
Okay. And that's one of those that like keeps me at night, like, oh, I tell them, hey, make sure your whoever's helping you with your 1040, that they're tracking basis for you. And then I in my stomach, I kind of worry. I'm like, I don't think they're even gonna know, or they're gonna do it. Oh, but yeah,
Yeah.
that's all we can do. But we need
Yeah.
to let it go, because yeah, we're not gonna get paid
Yes.
for tracking, but it's not the responsibility of the S corp at their level.
Mhm. But I'm curious how they file
Yeah,
taxes.
yeah,
So maybe for me, it's gonna be a good example to try to see and
yeah,
maybe practice with
yeah.
their information because I already have the information. Try
Oh,
to,
good. Yes.
yeah.
Yeah, I
And
like
then
to see other returns.
yeah.
Just kind of curious, like, would I have done it like this? Yeah. And I learn, I learned through some other returns too.
And then the other thing that I watching one of the videos, it was about the PPP because,
Yes.
well, I was working and I help a lot of my client
Uh-huh.
for the forgiveness, but I didn't
Yeah.
file the taxes. So,
Oh, okay. Yes. And
and I
that's
don't
what it
even
matters.
remember about that
Uh-huh.
specific schedule or seeing the
The
um,
M2.
with the
Yes.
information for the PPP.
Yes. And let me pull that up so we can kind of see. Um, and that's when I was working at Intuit, we got a bug reported, a defect reported by. So this is the thing, tax software companies. I'm telling you, I was working as a tax software developer. When we see defects reported by those clients that actually pay attention to like line by line, and they'll say, hey, this doesn't make sense, and then we have to look at it, and sometimes we determine they're right, we missed this completely, and all we do is release an update.
Mm.
And if you want to read the pages and pages that we tell you the preparer what was wrong, then you can find out what was wrong. But it's crazy. The liability, the software company is not liable because it's the tax preparer that is the expert. And that's what I tell people, don't rely on the software 100%. Yeah, it does a lot of great works, but still go in and like check line by line. Like, don't do the math. Line 1 + 2 should equal 3. That's easy math.
Mhm.
But do look at, okay, I have loss. Is the loss on my Schedule K1 flowing to my 1040? Is it? Okay, but did I do the 6198,
Mhm.
the basis, the at risk basis? And if I do it and I don't have at risk, why is it still flowing to the 1040? Just things like that we need to make sure that we're understanding the flow. And so I'll share my screen. This was a defect, a bug that was reported to us, and my team was in charge of the 1120s, and we're like, oh, we missed that. So what happened during the PPP loan,
Mhm. Mhm.
you had a liability on your books. It was, the government let you borrow money. It's a loan. And then one day they said, hey, everybody's forgiven on this loan. And what's the general rule? When we're forgiven on credit cards, on any kind of debt, they become taxable income,
Mhm.
right? When it's a credit card, it comes on that 1099 COD, I think it is. Um, this part where we messed up as a tax software company is that the expenses that were being used to generate that loan, that you paid, some people were paying companies to apply for this loan for them. Those expenses are not deductible because that it generated tax exempt income. And so we had it here. The forgiven loan, we were adding it as here under the AAA account as an other addition. And yes, it was non-taxable income. It should have been on other adjustments account. And we weren't doing that because other
Yeah.
adjustments account, it
Uh-huh.
gets broken differently in a separate column. And this is the thing about S corporations, like you have to think about the profit and loss statement, right?
Mhm.
We're going through each line. What is a separately stated item, which is what matters for Schedule K here. All of these, if we see on the profit and loss statement, these type of, you know, uh, items, we know that they're not going to go on page 1 as the general income and deductions.
Mhm.
They're going to flow down to, they're going to be separately. We have to extract them and be part of here. Which another one that a lot of practitioners, it throws them through a loop, is the Section 179 deduction. If the business, because last year bonus depreciation was limited to 60%.
Mhm.
So the next best option is take Section 179. It's 100% write off. But on the S corporation, you didn't see it here, and so a lot of preparers were confused because you don't see it here as a depreciation expense because it's a separately stated item,
Mhm.
Section 179. Because it all depends. We know Section 179 is limited to the income for that one shareholder. So that shareholder could have generated, it can't generate a loss, Section 179. So they take the loss at their Schedule E on their 4562, on their 1040. But if it's generating a loss, it's disallowed and it gets carried forward. It's just one of those that they make it so difficult for us on separating a lot of this stuff.
Yes.
So yeah, so tax exempt income down here. This is where PPP had to go. When it was forgiven, it's income, but tax exempt income. And we, as a software company, we weren't putting it there. And because it never came here, the way our calculations were working in the background, we would always pick up the amount that was here to make it flow to the Schedule M2 here. But since we failed to put it there, and the client reported it, and we're like, oh, you're right, we should have put it in here, and we didn't. So we had to create a brand new input field for the clients to say, this is the amount of forgiven tax. So yeah, a forgiven loan.
Yeah. I always got confused, and I don't even remember.
Mm-hmm.
I mean, because I was on charge of keeping the taxes, or have a review, because I was a
Uh-huh.
bookkeeper.
Yeah.
So I just to make sure that the 1120 it's in my books,
Uh-huh.
right?
Yeah.
But I don't even remember how they file for the PPP, because
Mm-hmm.
this specific company, they have the PPP, the first one, the second
Uh-huh.
one, the SBDIL, or I don't know the other
Oh
one.
yeah, the EIDL.
Yeah.
Yes. Yes. Those were some times. And I had some friends of mine that have businesses and tried applying for the PPP, and they didn't get a PPP. They got SBA, which was with interest, not
Yes.
forgiven. And
Hmm.
why? Because these big companies were getting those PPP. They were eating up all those funds. It was really sad.
Yeah.
Um, One of the things about the Schedule M2, it looks intimidating, like it has 4 columns, but really this needs to be completely gone. Like I want the IRS to like run a research and a survey, like who uses Schedule column B, and if nobody has used it in the past 10 years, just get rid of it, because Schedule or column B is only for those S corporations that were in existence prior to 1983. And it's so rare. I'm telling you, in the almost 20 years that I've been in practice, never have I seen an S corporation that was formed before 1983. Because most of the times they grow, maybe the business grows really big and then they become a C corporation to take advantage of the small business stock exemption, or they dissolve, or they go into different S corps. It's very rare. And everybody that I've met in the field, I'm like, have you ever filled out column B? And they don't. Nobody has ever come across a scenario with column B. Um, so yeah, when the distribution, it just matters here on line 7. When distributions come out to the shareholders, it has to go in this order. First, it goes through schedule or through column A. Column B, like I said, unless your S corporation on page 1 says that it was formed, or yeah, here the effective date. It was formed before 1983, then we have to worry about it. The other one is schedule or column C. This is only if you were a C corp before.
Hmm.
And again, I only saw it one time in practice when I was in public practice, and never have I seen it again. And if I have a client that's a C corp, I don't tell them let's elect to become an S corporation. I say let's dissolve the C corp
Okay.
and then become the S corporation.
I noticed, I want to mention this before. I noticed in
Uh-huh.
California,
Hmm.
and I'm going to say, because I have two different meetings with two different business owners.
Uh-huh.
They're contractors,
Okay.
and they have ITIN number. So
Okay.
California, the one that um, get the license. I'm not.
Uh-huh.
I remember board of something, California board of.
Uh-huh.
They help them organize the company. So,
Okay.
in order for them to get the license for the contractor
Yeah.
license,
Uh-huh.
they have to be an corporation.
Mm.
So they create the C Corp for them. They have
Yeah.
everything. And when I asked them who helped you, and they said that it was this board or something
Yeah.
California.
Uh-huh.
And then one of them received a social this year.
Oh, okay.
But it was the
Okay.
first year for the corporation, the
Okay.
C Corp.
Okay.
And he received the social. And I was trying. I remember that I mentioned about being an S Corp, but he
Uh-huh.
didn't have any gain. It was losses for
It was
2020.
all losses on the C Corp.
Yes.
And it was at that point I wouldn't convert them to an
Yeah.
S Corp. I would
Yeah.
just dissolve it, do a liquidating distribution from the C
Mhm.
Corp. When you close it, if there's any money left over, it's a 1099 dividend to the shareholder as a
If any.
liquidating distribution. If anything's left over, yes.
Yeah.
Yeah,
Okay.
because once, yeah, converting over to an S corporation like that, again, it's this right here, this accumulated earnings and profits. What that is a C corp. So when you're a C corp, you have to pay 21% tax.
Mhm.
And then any profit, that you have in the C corp after paying all your expenses, after paying the tax, if there's any more money in there in the bank account and the shareholder wants some of it, the C corp can distribute that money to the shareholder, but they have to issue a 1099 dividend. It's a taxable dividend. So then the taxpayer on their Schedule B has to put how much dividend came in, and it's subject to tax rates. To ordinary or dividend, it's qualified dividend if they've had the C Corp for more than 12 months. So it's subject to 15%. And so it gets taxed twice, right? Because their income was already taxed at 21%. And then anything left over, you can't just use it. Like it's an S corporation. Anything left over passes down and is only taxed one time at the 1040 level. The C Corp pays a tax and then distributes it. And if they decide not to distribute anything, they say, no, we just want to keep this money to reinvest for the business, then it goes into accumulated earnings and profits. It's almost like retained earnings
Mhm.
because you're holding on to it. But the IRS penalizes you as a C Corp. There's like a tax if you're holding on to too much money because the IRS wants to tax you on that. It's double tax. And so there's a law. I forgot the amount of, like, if you accumulate so much more than a certain amount of money and you haven't made a distribution, then they're going to charge you a tax. And so then when you become an S corporation, and if you still have in that bank, accumulated
Mhm.
earnings and profit, you have to bring it here. And then any distribution that the S corporation takes out, of course, it's going to go here on line 7. It's going to first go through here, try to go here. And if there's not enough of a balance on line 6, it can't be negative.
Mhm.
So you don't put it here. Instead, it has to come out of here. And at that point, they get taxed a dividend because it's coming out of here. You can't escape the dividend you would have had to pay anyway when you're a C Corp. They still want you to track it. So yeah, then it comes out of this balance, and you have to the S Corp has to issue a 1099 DIV to the shareholder
Mhm.
for this.
Yeah.
But yeah, this is in the 4 columns of the Schedule M2.
Yeah. And for me, it was I didn't even try the second time for the test
Uh-huh.
just to make sure to get us 100. Uh,
Oh,
I
for the quiz. Yeah. Let's look at it. Okay. I know Marty said 9 says which statement is not correct. So the AAA account, which is that first column here, it's called
Mhm.
AAA for short. So the AAA account tracks S
Uh-huh.
period earnings and generally funds tax-free distributions to reduce basis. That is correct, right? Because everything, all the activity, the here from the S corp is going to be coming in here, and distributions are going to come out of here first. So yes, the AAA accountant is right. The PTI, which is the previously taxed income, which is column B right here, income previously taxed, is pre-1983 previously taxed income and is rare in modern cases. That is true.
Mhm.
Again, I've never come across one that is older than past 1983. A, E, and P, which is accumulated earnings and profits, that third column, causes distributions to be treated as dividends to the extent of whatever you have in there. That is true, right? Because we said when you were a C Corp, you're going to have this column filled in. And if you no longer have AAA balance, the distribution cannot go below zero. This can't be negative due to distributions. Then it's going to have to come out of here. And that's where it's going to get taxed to the shareholder as a dividend. And then the OAA, which is the fourth column, includes items like tax exempt income and related non deductibles. It precedes AEP in the distribution order. Is that the one? Right? Precedes means it comes before. Oh, that was a little tricky.
I have that one.
That is a little tricky. I'm gonna tell Marty. Yeah, if you read it like a normal person, it gets confused. But then I guess you have to like really read it. Then okay.
And I was back and forth reading the PDF, and
Yes.
then going back to the test, and
Uh-huh.
but I got it wrong.
Oh, okay. No worries. Yeah, I see. That's a tricky one. So if we go, what is the correct order of basis of loss limitation
Yeah.
of an S corp shareholder?
Mhm.
We know the very first thing is basis,
Risk.
and then at risk, and then passive, and then excess. Okay, so that one's that. A shareholder has a K1 loss that might be limited. Which form does not commonly apply? If we have a loss, we know that for sure the 7203 has to come into play, regardless, right? Yeah, and the IRS only requires us to file the 7203 if there's a loss, or there's a distribution, or there's a sale of stock. But we are going to do the 7203 regardless. I always do it so that my software can do the calculations for me and it can roll it over to next year so that I know what my beginning basis is next year. The 6198 is the third test, or the second test, which is at risk. The 8582 is the passive activity loss. Also, that's the third test, but only required if it's a passive activity. If the shareholder is not active in the S Corp, they're more like a silent shareholder that they came in and just invested money and it's not doing anything, then we have to, for that type of shareholder, we have to do the 8582. The 461, which is the excess business loss, a new limitation that came to us starting 2018, which is pretty high. It's a high threshold, but it really, I did see some in practice of some pretty big losses. I mean, people are losing like millions of dollars in businesses. They're just, this is where it came in and said, no, the most you can deduct per year is what the annual limit is. So which is not the 4562. That has nothing to do with basis depreciation.
Yep.
If we calculate start of the year stock basis is 8,000, debt basis is 2,000, and the loss that we have is 15,000. No other items. What is the allowed loss this year before even going into the second test of at risk? So we have allowed stock basis. We can exhaust all of it to zero. So 8,000 out of the $15,000 loss we can deduct. And then we have $2,000 of a loss. And then so we have 10,000. And the loss that gets suspended is 5,000, right? Because we were able to take 8,000 and 2,000.
Yeah.
Which items generally increase a shareholder's at-risk amount in an S Corp? Select all that apply. Oh, I thought I got rid of these. Select all that apply.
And I think that's
Okay.
the only one that I
Oh, okay. So what increases is the cash, because you're liable for cash. It's your money. If anything happens, you're out of cash. A direct recourse loan, Recourse loan is one that you are personally guaranteeing. Non-recourse is one that you will never, they can't come after you if the default happens. The corporate non-recourse borrowing with no personal liability. Corporate non-recourse with no personal, okay. So it's a non-recourse and it's also no personal liability. That will not increase at risk. We're not at risk for any of this default that happens. And shareholder guarantee of a bank debt with no payment ever made. Yes, that's going to increase, even if no payment has ever made. But the key is the shareholder guarantees that. Activity income allocated to the shareholder. And what this means, it's what we see on the K1, income that's coming on the K1. Because remember, the shareholder has to pay tax on that. So it's going to increase our basis. Our skin is in the game for, we are at risk for this activity that comes down, the profit and loss that comes down. Which is most consistent with material participation for passive activity loss purposes? And is it 60 hours that are total, 60 hours total spread over the year, 100 hours, but less than any individual? 120 hours and no one else participates other than the shareholder. I am going to be honest, I don't memorize these 7 tests for passive activity loss, so I'm not even going to try to guess. Because which is most consistent? 300 hours supervising as a board only member. That doesn't seem right if you're only doing board decisions. 120 hours and no one else participates more than the shareholder. I think that's it.
Yeah, that was
right.
I think.
Okay. Yeah, because it could be very little bit of hours, but as long as nobody else participates.
Yeah.
One of the things that happens with the short-term activity, like the Airbnbs, of why if you have a loss on a rental, remember it by general rule, it's going to be a passive loss because it's rental, it's real estate. But the loophole that we have for short-term rentals like Airbnbs is that can you classify that loss as a against other income? No longer passive, but can you make it non-passive loss, which is what we want to offset W-2 income? And it really is only if you meet, they have 5 tests for that. And one of the tests is this, that you are working at least, I think it is 100 hours, at least 100 hours, but that nobody else is working more than that. And so the landscaper, the property manager, the cleaning lady, yes, like if you add up everybody's time in that rental, but if you are working more than everybody individually, then you win. There's companies that are created solely for this. And what they do is that they make sure that they have a landscaper working the first half of the year. The next half of the year, they hire somebody else. And so really, this first landscaper didn't work more than 100. This other one, it was divided. And this is the things that they do to kind of manipulate it. Like, no, nobody else has been working more than the owner. And then if you go and stay at the Airbnb, that counts as your time invested in this real estate. So you can go for a whole week and stay there. But you say that you're there to test out things, make sure that the electricity is working. I mean, they do all this documentation in the background to make sure that your time is counted as more than anybody else investing into that property or working on that property. And so it's all the.
Okay, what about if the Airbnb it's one room in your house?
If you're doing an Airbnb of a room in your house, is that, and it's a short-term rental, right? Because everybody who's coming in is not renting it more than, I think it was 7 days in average. One of those that in total, in average for everybody. Because somebody can rent it for like 60 days, but if the next person is 1 day, another person is 1 day. But in average, if you take an average, if it's less than, is it 7 days? I think 7 days, one of those. Yeah, so let's say it's a short-term rental. How would you be able to, you would be able to deduct if you have a loss, maybe depreciation was too high, you're able to deduct that loss against your W-2 income. because that portion is a short-term rental.
Yeah.
The only thing that would worry about, or not worry, but I would say, do I want to, at that case, you're kind of getting rid of your 121 exclusion for that space. Because you can sell your property and we don't have to pay income tax on that gain if it's our personal residence, if we're single up to 250,000, unless I don't think my gain's going to be even close to the 250. But yeah, I mean, it's all tax planning. Maybe that year my ordinary income with W-2s and business was super high and I'm looking for somehow to decrease it to not pay too much tax that year. It might be worth it.
I remember
do
I
it.
saw one client in my previous job that
Uh-huh.
they have a big house. I mean, in
Oh, like a
California.
mansion.
Yes, but he started receiving an Airbnb 1099K,
Oh, yeah.
and I remember it wasn't a Schedule E, but now
Schedule
that
E. Yeah.
yeah, but now that you mentioned, I'm not sure.
Yeah,
So
it
it
would
was
be. It would be on a Schedule E. All
okay.
rental is going to be on Schedule E. Just that
Oh,
when you have a loss, at that
mhm.
point, is it passive? Is it going to go on the 8582? Because the rental loss, the same thing. It's going to go on the 8582. But if you're active, it's not considered passive anymore.
Okay,
So then it's
okay,
going to flow
gotcha.
over to the 1040.
Okay, okay,
Or
yeah,
I guess it goes through
yeah,
Schedule 1 first and then 1040.
yeah, makes sense. Yeah.
Yeah. Okay, so which statement under excess business loss is not true? It applies after bases at risk and passive activity. Yes, that's right. It's the last test we have to meet. It's computed in the aggregate across all business. Yes, that's true. You have to gather all the businesses' losses together. Disallowed excess business loss gets carried forward. Oh, that's a typo. It gets carried forward. That's correct. It is computed entity by entity at the S Corp level. No, the S Corp does not have anything to do with excess business losses. Start of the stock basis is 5,000. Current year income is 2,000. So far our stock basis is 7, and our distribution is 9. The entire 9,000 is tax free. No, 7,000 is tax free, and we have a 2,000 capital gain that we have to put on the 1040. And then the shareholder has a loss on their K1 for $10,000. Their stock basis is 2,000. Is 2,000. Debt basis is 3,000. Okay, so for my math, we're able to take 2,000. So far, we have $8,000 of a loss. Can take another 3. So far, we have allowable loss of the 5,000. So we still have 5,000 left over. The shareholder is at risk for all the bases. However, they don't actively participate. The shareholder can take the 5,000 on their 1040. No, the shareholder cannot take any of the. Oh, wait. They do. They can. They can take. No. They can take. They have enough bases, but they haven't. They're passive, right? The shareholder cannot take any of the loss due to failing at risk. Correct, because they have the shareholder. Oh, they do have at risk. The shareholder cannot take the loss because they have failed a passive activity loss. Yeah. And that's what we take care of for my client that I think I told you he has a landscaping company, but he's very like in the background. Like he's retiring. His son is the one that's taking over. His son shareholder, super active. And so the dad, it's a passive activity. We haven't had any losses, but I always keep that in the back of my mind. If we have a loss on the K1, I'm going to have to go through all these tests, and then it's going to be passive loss for him. The thing is, on the 1120S K1, we don't have a box for like limited or passive. So see, there's nothing here. If we look at a 1065 K1 for a partnership, you do mark the partner if they're passive or they're a general partner right here, or not passive, if they're limited. If you're a limited partner, then this activity on a partnership is passive. And so when you have a loss here and you're marked as a limited partner, then you fail the passive activity loss test unless you have other, or well, no, you can't. You stop and then it gets carried forward. Um, that's the thing that I see sometimes with clients when they're marked as limited partner, but they're very active. I'm like, you're not a limited partner. We need to make you not a limited partner. As and it all depends if they have, even if their partnership agreement says so and so is the general partner, they're the ones who pay the self-employment tax, right? But then the limited partners, if they're active, the IRS is going to be like, you're actively working. You need to pay self-employment tax. No matter if this is marked and your partnership agreement says that you're limited, at the end, you are active in this partnership. And so sometimes we can't rely solely if they've checked the box for limited partner. If they're active, they're going to be subject to self-employment tax. And I put 11. Which schedule on the 1120S tracks AAA? All of these we know it's the schedule M2. Is this statement true or false? The suspended loss due to failing basis or failing the basis limitation can be lost forever when the shareholder disposes of their S Corporation stock. Yes. Did I get 100? I got one wrong. Which items generally increase? Corporate non-recourse borrowing with no personal. Okay, I won't waste your guys' time. I'm gonna make sure I check that. And if I have to correct it, did I do something wrong? Okay.
So,
Do
so the
you
one that so the one that shows is the one that should not have been selected is shareholder guarantee of bank debt with no payment ever made. That's what got that answer wrong.
at risk? Shareholder guarantee of bank debt with no. This right here, shareholder guarantees the bank debt is. You know what? I need to correct that because I might have thought it was debt basis. Um, because that's a very like limited time when the S corporation has a loan with the bank and you don't consider that debt basis. But if the shareholder is personally making the payments, then it is debt basis because it's not coming from the S corporation bank account, it's coming from the pocket of the shareholder. It really is debt basis. And that I did put on there. I remember in the notes when I was creating the content, it is. So yeah, if you can help me, George, correct that on your end. Um, this is the correct answer. Okay.
So it should have it correct.
Yes. So all these four should
You just wanted to
apply.
get up 100.
Yeah. How are you doing, Lisa? Is there something that maybe you're doing and you're like, oh, I can't. I need more time
Oh,
for this one specific
I
subject.
the S Corp to me, I'm not ever familiar with it. I kind of touched one,
Uh-huh.
but I felt lost. And I said, oh my God, maybe I can do this. Maybe this is not something I can do. So, and also my personal life, I think of it
Yeah.
a
Yeah,
little bit.
life happens, but I will tell you, I did not know how to do S corps. I wasn't born knowing how to do S corps. It comes with just learning and practicing, asking questions. And so yeah, don't feel like even after you take the master class that you're like, "Oh, now I know exactly every single intricacy that's going to come with an S corp." There's still going to be questions. And sometimes even when I'm preparing, when it comes with this basis, I step back. I'm like, okay, wait. Do I have to freak out about at risk? No, I don't have to even freak out. Or yes, I do. I have to make sure that I'm tracking at risk. Yeah, so there's always going to be learning. I learn something new every day, not one thing, it's many things that I'm learning as I'm going. And the way our tax laws keeps changing, it's always going to, our profession will always keep us always our brain sharp of having to learn and having to learn. And the best thing is just ask questions. Even if you're like, oh, but we're on lesson 7, I should know by now. No, you shouldn't. I don't expect anybody in class to like say, okay, I got lesson 1 through 7 on lockdown. I'm an expert. No, if we have to, spend a little bit more time on lesson 1 on just, is it a good, S Corp is a good route to take, even if it's questions like that. Yeah, it's going to come with practice.
Okay,
So yeah,
good.
so yeah, give yourself grace. You're in here today and you're learning and you have access to the recordings, you have access to resources, and you have access to the whole class. We can always ask the question. Ask the question. You can send me a question on the side and I can bring it up without having to say, oh, Lisa or Jessica asked me the question. I'll just bring it as a general question. So
Okay.
yeah, always feel comfortable and always know that every day we try. And there's some days that are better than others. There's
Yes.
days that I'm like, I don't want to do anything, and where did this day go? But yeah, no, we're all
Um,
doing our best, right?
I'm gonna add that I remember starting taking S Corp classes since 2023.
Mm-hmm.
My first, and I only did one was 2024, and it was
Uh-huh.
a new business. I
Yeah.
helped him. He was an LLC. I helped him with 2553, and then this year that I show you the one,
Uh-huh.
and for me it was a big one, and I was
Yeah.
stressing because I didn't know if I think the imposter syndrome was
Oh yeah.
kicking in, and of course I didn't know until I talked to you one on one and you
Uh-huh.
helped.
Yeah.
And for me, this is my fourth class on
Uh-huh.
Expert. And this is not the first time that I'm gonna mention, but I'm learning a lot. I'm
Uh-huh.
feeling okay. I'm gonna be ready for next year. Now
Yeah.
I'm ready. I can
Yes.
take clients that it's not a new client, a completely new company.
Yes. It's an existing S Corp.
Yes,
Mm-hmm.
because I'm scared about that, those
Yeah.
ones.
Yes.
But now I'm feeling okay. I think I'm ready. And then
Yeah.
I have Nadia. I have
Yes.
all the community,
Yes.
and I feel like I'm learning a lot.
Oh yeah.
Sometimes it's
Yeah.
confusing, yes,
Uh-huh.
and I get
Yes.
stuck. And this is the first time that I'm listening to this. But
Yeah,
yeah,
that we're learning about at
oh
risk and access. Like these are advanced topics, but we need to get familiar with them
yeah.
because yeah, it comes into play when we're helping that shareholder. And the worst thing is when the IRS comes and says, "Prove to me that you had enough bases on all these 4 tests to take that loss." And we know that sometimes the client, even though at the end of the day, yes, okay, they're supposed to track bases. They're never going to. We're always going to be the ones tracking it for them. We're the first ones to get blamed, of course. We should have known. And it's one of those that we're here learning. Even if we have a faint, like, oh, I remember we have a loss. That's my antennas are going up. I see a loss on the K1. I know I have to meet some tests before we can make this K1 loss flow to the 1040. And I have to prove with those forms that we're good to take this loss. Mhm. But yeah,
Yeah.
no, you're doing
It was
great, Lisa.
I felt intimidated, and then one day I couldn't get in the class, and I felt so sad. I was like, they left me
Oh,
out, and
oh
I
no.
swear I said, "Girl, my hormone something." Me andaba chillona. Even something happened so simple. I go, "Oh my God, that's me. It's just me. It's not them." And Jorge, me castigaste de la clase, and
Oh.
I needed time off. I just said, I
Never.
can't.
No,
I'm glad. I'm glad. Thank you. I appreciate this space. You are a
Mhm.
great teacher. You're very patient, and
Thank you.
you're who I would connect with more than louder, faster people. This is more
Yes.
my heels.
Yes, I
Yeah.
agree 100%. Yes,
Thank you.
yeah.
It's good.
I really appreciate that. I really appreciate that because yeah, there's other instructors I've seen. And it's my teaching style and my learning style is more like calm. Okay, let's take a deep breath. We'll take it one step at a time.
Yeah.
And if we have to ask questions, we'll ask questions. The more we ask, the more we're going to learn. And so yeah, I'm glad you're enjoying the class and that you're learning something from it. And again, Lisa, you have the one-on-ones.
Mhm.
Whenever you're ready to use them, we'll set time. Jessica used one, and we worked on one of her clients together. And we
Yes.
walked it
I do
through.
have one, but I'm waiting on them. I can't do
Mhm.
it for them. I can't
Yeah.
go call their bookkeeper. I can't do that. So
Yeah.
I told them,
Yes.
but I can't do it as much as I
I
want
know.
to.
Sometimes we do that. We worry more for their things than they worry about their own things. Yeah.
I'm like in the cloud. Oh yeah, I'll get to it. Don't worry. I'm like,
Uh-huh.
you're getting in trouble.
Because we know the fear that they're going to come to us like a week before the deadline.
Yes,
And
that's
and I
exactly what I'm
promise,
saying.
I promised myself, like, okay, this time I'm not gonna give in. Or I've heard that some people charge a rush fee. Like, okay, you
Mm.
didn't meet my deadline. I can do it 7 days before, but there is a rush fee to put you in front of the line.
Yeah.
Yeah, and
Oh,
I'm gonna
okay.
put that in my engagement letter. I'm gonna work on that during Thanksgiving. George and I have all these ideas for Thanksgiving week. We're taking it off. Of like, okay, I'm gonna sit down. I'm gonna do my pipelines. I'm gonna work on my engagement letter to add
Yeah.
a rush fee that it says, hey, if you don't meet the deadline that's stated. And so I need to come up with my deadline today or like during Thanksgiving so I can look at my engagement letter and say by March, I don't know, March 1st. And if you don't bring me that stuff by March 1st, then there will be a rush fee. I don't know how much, 500. Something that hopefully scares them into and then makes me feel one of the girls I was talking to
1,500.
1,500. Somebody was telling me you need to charge a price that you don't feel later resentful about.
Mm.
Because if you're going to charge 500 and you rush it, and then later you're mad at yourself, like, oh,
I
I'm
know
still
that
doing
has
this
happened
return. Yes.
many times. I've been through that,
What
and
price
I
can make
feel
me
sad.
feel not resentful
Mhm.
of doing this, of like excited to do it. So yeah. Yeah, George is the one that you need to charge more. So we're gonna work on that this week, this Thanksgiving week, on coming up with the price structure.
Nice.
Yeah.
Mhm.
Thank you. I appreciate everything here.
Yeah,
And
of
I
course.
appreciate Jessica sharing her. She has great questions. And Marty.
Oh yeah.
Sometimes, and I'm sorry, sometimes I feel bad because I think I asked
No.
well.
No, not at all. And like you said, like Lisa right here appreciates just listening in to the question and the answer.
Yeah.
That happens to me too in classes. I'm like, oh, that was a good question. What's the answer? Sometimes, yeah, I'm like,
Right.
I'm still trying to grasp what I learned to
Mhm.
even have a question.
Yeah.
Yeah.
Yeah. And maybe because I have more experience. I mean,
Yeah.
what I try to say that because I work with somebody that it was doing that, so
Mhm.
that question at that moment I wasn't the one doing the taxes or preparing the
Uh-huh.
taxes, but okay, that's a question that I
Yes.
have.
Yes. Yeah.
Yeah. So yeah,
Yeah.
and I'm
Okay.
glad because the previous class I said okay, keep it quiet.
No, not at all. Not at all. We're going to answer everybody's question and make sure that we're all learning. And even if it pops up later tonight, just put it on the discussion hall
Okay. Yeah.
and we can talk about it, through chat, but also bring it up in the next class.
Okay. Yeah.
Mhm.
Okay.
Okay.
Thank you.
Thank you again for being here. I don't know what happened to everybody else. I hope everybody's okay.
Maybe
I reached
because
out to
today's a holiday.
I don't know. I
Oh,
reached
today
out to
is veterans, right? Uh-huh.
Yeah.
Oh, maybe they thought we were on the too.
I know. It's a federal
Oh,
holiday.
you
I
know
tried
what?
calling the IRS this morning and I got their voicemail that it's a federal holiday.
I know
Like, oh,
PD. We chat on the
uh-huh.
side, and I'm like, "What
Yeah.
happened? Are you okay?" And she's like, "Oh, I forgot about class." But she's a veteran, so
Oh, we
I
need
think
to shout
today's
her
the
out.
yeah.
Yeah.
She's a veteran, so she just texted me. She's like, "I forgot about class," so I think that's why.
She's enjoying
It
her
doesn't.
day. And we're gonna thank her for her service on our chat. I'm
Yeah.
glad
Yeah,
you brought that up.
Yes. Yes.
Mhm.
that'd be good. Okay.
Okay. Well,
Thank
thank
you.
you both for being here, and Marty that joined us in the morning a little bit earlier today. But again, use the space, discussion hall, any questions that you have. And if you have to rewatch at risk, we're going to continue it on the next session, the next lesson, where we're going to look at a tax return. So we can see the form. Once we see the theory, we heard the theory. Now, how does that apply on the form? Because that's how the forms are structured. But excited to see you next week. And we see you again tomorrow tomorrow's Wednesday, for our session, our introduction to tax advisory.
Mhm.
I'm going to bring that over to you tomorrow for at 1 p.m. my time. Central or Pacific is 11 a.m.
Yeah.
Mhm.
Very good.
Okay, we'll
Thank
see you. Take care, everyone. Bye.
Thank